Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video that you're in the best of health and spirit. This video will cover Chapter 3, Business Income and Expenses. By the end of this chapter, you should be able to complete a basic Schedule C, which reports profit and loss for a business, describe the tax treatment of inventories and cost of goods sold, identify the requirements for deducting transportation expenses, identify the requirements for deducting travel expenses, determine the requirements for deducting meals, identify the requirements for claiming business education expenses, identify the tax treatment of dues and subscriptions, determine which clothing and uniforms may be treated as tax deductions, explain the special limits for business gift deductions, explain the tax treatment of bad debt deductions, ascertain when a home office deduction may be claimed and how the deduction is computed, and lastly, apply the factors used to determine when an activity is a hobby and understand the tax treatment of hobby losses. So as far as this chapter goes, it covers Schedule C, the profit or loss from businesses, essentially a sole proprietorship. In addition, a person who has a single member LLC for federal purposes is treated as a disregarded entity. And for tax purposes, they also need to file this Schedule C. So for this chapter, it covers that Schedule C and many of the common business expenses that are allowed as deductions in arriving at the net taxable business income. So Schedule C is filed by self-employed taxpayers such as accountants, doctors, lawyers, architects, consultants, etc. Right? So this form is one of the most commonly used tax forms. And for many people, the net income that's reported on Schedule C is a primary component of their adjusted gross income. So as it relates to Schedule C, a trade or business is not formally defined in the Internal Revenue Code, but is generally any activity engaged in for profit. So that's one of the benefits of a sole proprietorship. Someone can wake up one morning and say, hey, you know what? I want to start a business. They do not need to file any documentation with the IRS or the state. They basically just start the business, right? So that is why it is defined here as a trade or business that's not formally defined in the Internal Revenue Code. So as it relates to the expenses, one of the key things is that you need to determine whether or not it can actually be deducted. So for an expense to be generally considered deductible for a trade or business, it must, first and foremost, be ordinary and necessary. 2, have a legitimate purpose. And 3, be reasonable in light of the fees that are generated as a result of the expense. And just to, discuss a bit more regarding the Schedule C, one key thing to keep in mind is that there's a section of the Internal Revenue Code, Section 162, and it essentially states that a taxpayer is allowed to deduct all the ordinary and necessary expenses in carrying on a trade or business. And generally, a trade or business for tax purposes is any activity that's engaged in for profit. So just keep in mind, the individual does not necessarily need to make a profit through regular and continual effort. However, you want to be able to make sure, is this really a business or is it just a hobby? Because as you'll see with Schedule C, if there is a loss, this is considered an ordinary loss and it offsets an individual's other income. And this is one of the ways in which a lot of persons commit fraud, unfortunately, on their tax return. They create businesses intentionally to have a loss, so therefore it can lower their tax liability. So just something to be aware of. The Internal Revenue Code restricts the deduction of certain expenses such as personal, living, and family expenses, capital expenditure, expenses related to tax-exempt income, expenditures related to the sale of illegal drugs, illegal bribes and kickbacks, fines, penalties, and other payments to governments related to the violation of law, lobbying and political expenditures, any settlement or attorney fees related to sexual abuse or harassment if it is subjected to a non-disclosure agreement. So just keep in mind this, essentially, again, the IRS and the courts, they have taken a fairly permissive perspective on the deduction of business expenses. However, there are some restrictions, as we just detailed just now. And as it relates to the Schedule C, as mentioned, Schedule C, it's used by sole proprietors as well as members of a single member LLC to report profit or loss from their business. There's 5 parts of Schedule C. Income, which is part 1. Expenses, which is part 2. Cost of goods sold, which is part 3. Vehicle information, which is part 4. And other expenses, which is part 5. For all individuals that have a business, they need to also file Schedule SE. All right. And another thing to keep in mind is that for the individual, whenever they have net earnings of $400 or more, they have to pay self-employment tax. And in order to pay that self-employment tax, they have to file Schedule SE with Form 1040. So self-employment tax is made up of 2 taxes: Social Security tax, which is 12.4% on the first $160,200 of net self-employment income, in addition to Medicare tax, which is 2.9% on all net self-employment income. So, as you just pointed out, the self-employment tax is made up of these 2 taxes. So one key thing to keep in mind is that, let's say you are an employee for a company. When you are an employee at that company, you are responsible for 1/2 of Social Security. So the employee pays 6.2% and the employer pays 6.2% for a total of 12.4%. As it relates to Medicare taxes, the employee pays 1.45% and the employer pays the other 1.45% for a total of 2.9%. As a self-employed individual, you are considered both the employee as well as the employer. Hence why we see here that they are responsible for the 6.2 plus 6.2 for a total of 12.4% for Social Security tax, and for the Medicare tax, 1.45%, and the additional 1.45% for a total of 2.9%. But one key thing to keep in mind is that half of the self-employment tax is allowed as a deduction on Form 1040 in order to calculate adjusted gross income. So again, self-employment taxes is similar to FICA taxes that are levied on employees, partly through payroll withholding and then partly through employer contributions, as mentioned. So just keep that in mind. Next, we move on to inventories. So as it relates to inventory, inventory is basically the stock of goods or materials that a business holds for the purpose of reselling it to generate a profit, right? So let's say I go to Costco or a wholesale, company where I can purchase things in bulk, and I purchase cases of water, right? I'm purchasing the cases of water not because I need water in my house, but because I want to resell the bottles of water for profit. So let's say I purchase a case of 24 bottles of water. To make it easy, let's just say I purchased $10 for the case of water. So I purchased the case of water for $10. I'm going to sell each bottle of water for $1. So therefore, the cost of goods sold is $10. How much I'm going to make as a profit is $14. 24 bottles, I sell it for $1. So $24, which is my income, minus $10, which represents how much I paid for it. My profit is $14. So that's basically how I want you guys to think of inventory versus, let's say I went and I purchased bottles of water, but I purchased it for the office. So that way the employees can drink water whenever they're thirsty. The intent of why I have that water is not to resell it. That would be, considered like an office expense, right? So it's very important to distinguish between the two, especially when you are assisting with clients and you are preparing to schedule C. You want to differentiate, is this really an inventory? Are they really purchasing this asset with the intent to sell it, or are they using it in a normal course of operations? So cost of goods sold is often the largest expense for manufacturers, retailers, and wholesalers. Inventory accounting involves measuring the ending inventory by doing an actual count. So the key thing is we want to know, how much did we sell? That's what's referred to as cost of goods sold. So small businesses with gross receipts that are less than 29 million, they can use the cash method to account for inventory. There's three options. They treat it as a non-incidental materials and supplies. They treat it the same as on the applicable financial statements of the business, or they treat it as it conforms with the business books and records. So the cash basis method, it applies only to businesses that pay little attention to inventory. Most businesses, they have to determine the value of the beginning and ending inventories to calculate cost of goods sold. So inventory accounting, it involves measuring the ending inventory by doing an actual account. And there are two commonly used methods of inventory flow. We have what's called FIFO, first in, first out, and we have LIFO, last in, first out. So think of it realistically for a supermarket, right? Generally, especially when you're dealing with produce, groceries, you purchase bananas today, they start to turn, within a few days. So a supermarket is a great example of a company that would, utilize first in, first out. They essentially want to sell the goods that came in first. They want to sell those first. Versus last in, last out. With last in, last out, we could think of that like a retail, company. The retail company, the newest goods are, the hottest, the latest fashion. So they want to sell those newer items faster, right? Or first, rather. So depending on a company, obviously, that determines which costing method they are going to use to determine the flow of inventory. So a taxpayer may decide to adopt the last in, first out method by using it in a tax return, and then they would have to attach what's called Form 970 in order to make the election. So essentially, once the election is made, the method may be changed, but only with the consent of the IRS. So the IRS has to approve that change. And also, if the LIFO election is made for reporting taxable income, then the taxpayers have to use the same method for preparing their financial statement. So in other words, the taxpayer can't use LIFO for their tax return and then use FIFO for financial statements that's presented to a bank. So this is a rule that's strictly enforced by the IRS. Next, we move on to transportation. So certain transportation expenses for business purposes, they are deductible by taxpayers. So deductible expenses include any travel by airplane, rail, bus, the cost of operating and maintaining an automobile. All right. So the transportation expense may be deducted even if the taxpayer is not away from their home. Commuting, however, generally is not deductible except in the following three circumstances. So commuting, it includes rather the expenses of buses, subways, taxis, and operating a private car. But one key thing to keep in mind, again, commuting generally is not deductible except in three circumstances. First is travel between the taxpayer's home and work locations outside the metro area where the taxpayer lives and normally works. Two, travel between the taxpayer's home and temporary work locations if the taxpayer has a regular place of business. Three, travel between the taxpayer's home and other regular or temporary locations if the taxpayer's home is the principal place of business. And in all cases, taxpayers, they are allowed to deduct additional costs of hauling tools and equipment. So if the taxpayer works at 2 or more jobs during the day, then they may deduct the cost of going from one job to the other job, right? But again, if you are traveling from your home to your first job, that is not considered deductible. So it's very important to essentially keep this in mind, because a lot of times you will receive financial statements where the travel, they're reporting the full amount, but you need to ask the taxpayer questions to determine whether or not it actually can be deducted. And just keep in mind, the deductible expenses is based on the cost of travel by the shortest and most normally traveled route, even if the taxpayer uses another route. All right, so just keep that in mind. So taxpayers, as it relates to transportation, they are allowed to use the standard mileage rate to calculate the deduction of transportation expenses. So the amount is indexed each year for inflation. And for 2023, it's 65.5 cents. And 2024, 2025, etc., it increases. So most costs associated with the operation of an automobile, like gas, an oil change, insurance, repairs, maintenance, etc., as well as depreciation, is ultimately built into the standard mileage rate. So that's something to keep in mind. So a person might think, well, hey, why would I take the standard mileage rate if I'm gonna, lose the benefit of the gas I paid, insurance, etc.? It's built into it. So just keep that in mind. As it relates to parking and toll, that's related to business transportation. Keep in mind, transportation, not commuting, as well as the deduction for interest on car loans and state and local personal property taxes on an automobile, those are determined separately. So just please keep that in mind. So to use the standard mileage method, the taxpayer must, first and foremost, they have to own or lease the automobile. They cannot operate a fleet of automobiles using 5 or more simultaneously. They cannot have claimed depreciation on the automobile using any other method than the straight line depreciation. And they should not have claimed Section 179 depreciation or bonus depreciation on the automobile. If the taxpayer does not use the standard mileage method in the first year, it's not available for any subsequent years. So if the taxpayer is entitled to use either the actual cost of the standard mileage method, they essentially select the method that results in the largest tax deduction for the first year. And as just mentioned, if the taxpayer doesn't use the standard mileage method in the first year, the method is no longer available for any subsequent year. And if there needs to be a change to the actual cost method, it can be made in any year. And if after using the standard mileage method, the taxpayer uses actual costs made in any year. So it's very important to keep that in mind. The following formula is used to calculate the deduction when using the actual cost method. And it's the actual expenses multiplied by the business use percentage. And how do you determine the business use percentage? You would divide the business miles driven by the total miles driven for the vehicle. And from there, the business use percentage is applied to the total automobile expenses for the year. This includes gas, oil, repairs, depreciation, insurance, etc. So any automobile expenses that were incurred during the year, you essentially multiply it by the business use percentage, because it's not rare, but for the most part, a lot of times self-employed individuals, they use their vehicle for both personal and business related driving. But if a taxpayer has a separate car for business and a separate car for personal, then it makes it much easier. You do not need to account for the business use percentage. Deductions for parking and tolls and fees, interest on car loans, and personal property taxes, those are determined separately. And the vehicle expenses, they're reported on Form 2106, and they're carried over to Schedule C or the other forms. So now this brings us to travel expenses. So travel expenses, these are defined as ordinary and necessary expenses that are incurred when traveling away from home in pursuit of the taxpayer's trade or business. So these expenses, they are deductible as long as they can be substantiated. They're not lavish and they're not extravagant. So other business expenses incurred while not away from home, such as business gifts, that's not, considered a travel expense, but they might be separately deductible. So just keep that in mind. So to be deductible, travel expenses must result from a documented and substantiated business reasons, as mentioned. Some deductible travel expenses include meals. Just keep in mind the cost of meals is only 50% deductible. And if an employer reimburses an employee for the cost of meals, the 50% limitation applies. In addition, lodging is included, taxis, tips, laundry. Travel expenses, we've covered this already, can be substantiated, not lavish or extravagant. The taxpayers away from their tax home overnight. So keep in mind, overnight, it doesn't literally mean 24 hours, right? But it is defined as a period of time longer than an ordinary workday in which rest or relief from work is required. And a tax home is defined as the taxpayer's principal place of business and is not necessarily the same location as the family's residence. So just keep that in mind. Expenses of temporary assignments, those are considered deductible if it's not practical to return home at the end of each day's work, or if the employer requires the employee's attendance at a business meeting, training, activity, or some other overnight business function. So if the assignment is for a long period of time, or let's say it's indefinite, generally more than 1 year, then in such case, the new location may be considered the taxpayer's new tax home, and they may be, they may lose the travel deduction. Deductibility is dependent on whether a trip is classified as business, pleasure, or a combination, right? So we just discussed transportation in a business vehicle, right? Or just a vehicle in general. Sometimes self-employed individuals, they'll use the vehicle for both business and personal. You need to allocate between the business portion and the personal portion. The same thing essentially applies to travel. When you travel, only the business portion is deductible. The portion that is for pleasure, that is not allowed to be deductible. So if primarily business trip is within the United States, all travel costs to and from the destination are deductible, but only the business portion of meals, lodging, local transportation, and incidental expenses are considered deductible. If primarily a business trip is outside of the United States, travel costs to and from the destination are split between the business and the personal based on the number of days. And then any business-related expenses incurred while at the destination, those are considered deductible. If the trip is primarily a pleasure trip, and this is within or outside of the United States, travel costs to and from the destination are not considered deductible. And any business-related expenses incurred while at the destination, those are considered deductible. So here we have an example. It says, Gabrielle, a sustainability director, travels from Idaho to New Mexico for a business trip and pays $380 for airfare. The lodging and meal costs are $330 and $150 respectively for the business portion of the trip. While in New Mexico, she goes on a personal sightseeing tour of the Turquoise Trail and spends $400 on car rental and lodging and $85 on meals. What amount may she deduct for business travel? All right, so as we see, there's a lot going on in this problem, right? So the $330, right, we see that's for the lodging and meal costs and $150 respectively. So since the trip was primarily for business and in the United States, all of the airfare is deductible, the entire $380. The lodging of $330 and 50% of the $150 business meals are also deductible. None of the personal expenses are deductible. So the fact that she went on the Turquoise Trail, and, you know, personally she rented the car and she also spent money for meals, that's not deductible. So therefore, we deduct the airfare, we deduct the business related lodging and 50% of the meals for a total of $785. So again, when you're dealing with clients, you want to make sure that you ask questions, you probe, because sometimes they will just report the full amount of the expenses incurred while away. But if any of the expenses are related to pleasure, to personal travel, then it is not allowed to be deductible. So no deduction for travel expenses is allowed unless the taxpayer keeps proper records. The taxpayers must substantiate the following: the amount of each separate expenditure, such as airfare and lodging, dates of departure and return for each trip and number of business days on the trip, the name of the city or town of travel destination, and the business reason for the travel. And we also have what's called this per diem substantiation. So instead of requiring the actual expense records, because imagine, let's say you have someone that has a business and, you know, they constantly travel. They're, you know, traveling for seminars and traveling for, you know, education and things of that nature, networking, etc. In such case, there's this alternative to reporting actual expenses. And employers who reimburse employees for travel expenses, they can choose a per diem method of substantiation. So per diem, this is a daily allowance used for business travel expenses while away from an employee's tax home. And the primary advantage of using the per diem method to substantiate expenses is that it eliminates much of the record keeping that's usually associated with travel expenses. So the IRS has approved 2 per diem methods to substantiate travel expenses. The first is the standard per diem method, and the second is the high-low per diem method. So employers can use the per diem for all travel expenses. This includes lodging, meals, incidentals, or an employer can use the per diem for only meals and incidentals. As it relates to self-employed individuals, they may only use per diem for meals and incidentals. So the 2 per diem methods to substantiate travel expenses, we have the standard federal rate method. This is when an employee is allowed a per diem amount for travel equal to the current federal per diem rate, and this varies based on the travel location. The per diem amounts for each area of the United States. It's available at the U.S. General Services Administration website. So there's a specific link that you can utilize to determine what the per diem rate is, which is based on the travel location. Then we have what's called the high-low method. So with the high-low method, this provides a significantly simplified way of computing the federal per diem rate for travel within the U.S. So this method, it kind of helps to avoid the need to keep a current list of the per diem rates for the localities in the U.S. So under this method, a small number of locations are designated as high-cost localities, and all other locations are deemed to be low-cost areas. So starting in October of 2023, the high cost allowance is $309 per day, and the low cost amount is $214 per day. So if an employer uses this method to reimburse an employee anytime during the calendar year, then this method must be used for all travel for that employee in the same calendar year. So under either method, if they choose the standard method or the high-low method, the employee can use a current per diem amount for meals and incidental expenses only. Actual cost records are required for lodging expenses, and the meals and incidental expenses, they may be taken from the standard per diem rates table, or the high-low method may be used. So just something to keep in mind. Next, we have meals and entertainment. So as it relates to meals and entertainment, with the Tax Cuts and Jobs Act, there was a very big change for meals and expenses. So as it relates to meals and entertainment, there's no deduction for an activity that's generally considered to be entertainment, amusement, or recreation, membership dues for any club organized for business, pleasure, recreation, or other social purposes, Or lastly, a facility used in connection with any of the above. So entertainment costs related to recreation, social, or similar activities for the benefit of employees, however, those do remain deductible. So because meals and entertainment, they're generally, closely related, taxpayers, they should be cautious whenever they're deducting meals associated with an entertainment event, because again, you might be allowing a deduction when in all reality, it's not actually deductible. So client meals in which business is conducted and the taxpayer or the taxpayer's employee is present. And one of the key things is that it should not be lavish and it should not be extravagant. If those requirements are met, then typically it's 50% deductible. And entertainment related meals such as one associated, let's say, with a golf outing, a cocktail party, or some other entertainment event, it's only deductible if the meal is purchased or invoiced separately. So again, that's one of the key things. It has to be separate. Celebratory meals. So let's say a lot of firms, sometimes they have holiday parties, they have company picnics and things of that nature. Those are considered 100% deductible. All right. So just keep in mind, although entertainment related club dues are not deductible, any dues that are paid to professional organizations such as the bar or medical organizations, those are considered deductible. Next, we have educational expenses. And just a quick note, tax law for educational expenses has become very complex. So as far as this section of this chapter, it's dealing primarily with the deduction of continuing education expenses that are incurred by self-employed taxpayers. Qualified tuition programs, educational savings account, education tax credit, and education loan interest, it's discussed in other chapters of this textbook. So the suspension of the deduction for miscellaneous expenses subjected to 2% of adjusted gross income have been effectively eliminated because of the Tax Cuts and Jobs Act. So there was a very big change with the TCJA. So as it relates to educational expenses, they may be deductible if one of two tests is met. First, the educational expenses must be paid to meet the requirements of the taxpayer's employer or the requirements of law or regulation for keeping the taxpayer's salary, status, or job. The educational expenses must be paid to maintain or improve existing skills required in performing the duties of the taxpayer's present work. And expenses for travel or educational purposes. So any travel expenses that are incurred while away from home for trips that are primarily to obtain qualifying education, those are considered deductible. So here we have an example. It says Roxanne is a paralegal who attends law school at night at the University of Texas at El Paso. Are her educational expenses deductible? Assume that 30 hours per year of continuing education are required for paralegals to maintain certification in Texas. If Roxanne flew from her home in El Paso to a continuing education conference for paralegals in Dallas, are her expenses deductible? So the solution is the cost of attending law school is non-deductible. Why? Because the education would qualify Roxanne for a new trade or business as an attorney. Her expenses at the conference, however, would be deductible. The meals are only subjected to, or the meals rather are subjected to 50%. And this is allowed, these deductions are allowed because she's complying with the requirements to maintain her existing job. Now we move on to dues, subscriptions, and publications. So professionals such as doctors, lawyers, accountants, etc., those who engage in practice or employed may deduct the cost of related dues, subscriptions, and publications. So included in this category of deductions are items such as dues to professional associations, cost of subscriptions to any journals that is directly related to the taxpayer's profession. special clothing and uniform. So self-employed individuals and employers are allowed a deduction for the cost of special work clothing or uniforms. The deduction is not allowed for the general cost and upkeep of normal work clothes. The clothing must be specialized. So to be deductible, the clothing or uniforms must, one, be required as a condition of employment, and two, not be suitable for everyday use. Both conditions must be met for the deduction to be allowed. It's not enough that the taxpayer is required to wear special clothing. If the clothing can be worn while the taxpayer is not on the job. So the costs of protective clothing, such as safety shoes, hard hats, rubber boots that are required for the job, are also deductible. And if the clothing or uniforms qualify, then the cost of purchases, alteration, laundry, dry cleaning, and the maintenance is considered deductible. Next, we move on to business gifts. So within limit, taxpayers are allowed a deduction for business gifts. So salespersons and other taxpayers, they may deduct up to $25 per year per donee. So for purposes of this limitation, spouses do count as one donee. Thus, the maximum that a taxpayer could deduct for gifts to a client or a potential client and their spouse is a total of $25 per year, unless the spouse is also a client, in which case the spouse can receive a separate $25 gift. So in order to deduct gifts, the taxpayers must be able to substantiate the deduction. There's no limitation for small business gifts, up to $4 each if the taxpayer's name or company name is imprinted on the gift items. So this might be, items such as pencils, pens, calendars, etc. And there's no limitation on promotional material. Please keep that in mind, such as a sign or a display rack. A deduction for gifts of tangible personal property that's made to employees for the length of service on the job and safety achievement, it may be deducted up to a limit of $400 per employee per year. And if the gift is made in conjunction with a qualified plan, then the limit in such case is $1,600. And lastly, any gifts made to a taxpayer's supervisor or individuals at a higher employment level, those are not considered deductible. Instead, those gifts are considered non-deductible personal expenses. Next, we move on to bad debts. So whenever a taxpayer sells goods or services on account, again, you are expecting to receive payment from the client. So you debit accounts receivable and you would credit revenue, right? Because when you provide services or you sell a product, if you extend credit, it's either the client pays you now, they pay you later, or they pay you a portion now and will pay you a portion later. But the key thing is whenever there's accounts receivable, you always run the risk of clients not paying you, right? So bad debts arise when a taxpayer sells goods or services on credit and the accounts receivable later becomes uncollectible. A deduction for bad debts is allowed up to the amount that was previously included in income. So for taxpayers that are on a cash basis, because they did not report the income because it was not received, when they realize that the client is not going to pay them, unfortunately, they cannot claim bad debt because they never reported the cash as income, or the income, they never reported it because, again, under the cash basis, you only record income when you receive it in cash. So when there is a bad debt, taxpayers must use the specific charge-off method. The IRS requires proof that the debt is worthless as well as the amount of the worthlessness. So we have business and we have non-business bad debts. So bad debts falls into two categories: business bad debts and non-business bad debts. So debts that arise from the taxpayer's trade or business, those are classified as business bad debts, while all other debts are considered non-business bad debts. So the distinction between the two types of debts is important, since business bad debts are ordinary deductions and non-business bad debts are short-term capital losses. So short-term and long-term capital gains, it may offset the short-term capital losses. So just keep that in mind. But if there's a capital loss, it's subjected to the $3,000 per year loss limitation. So an example is, let's say there's a business bad debt of $9,000. It's considered an ordinary loss, so you can claim the full $9,000 in the year that the loss took place, versus if it is a non-business bad debt, it would take the client 3 years to write it off because there's a maximum for capital losses of $3,000 per year. So here we have an example. It says Kiko, a dentist, loaned her friend Lucas $20,000 to start an upholstery business. Subsequently, Lucas cannot repay Kiko. Is this a business or non-business bad debt? How much may Kiko deduct in the current year? So in this example, this is considered a non-business bad debt because Kiko's not in the business of loaning money, right? So it is a short-term capital loss limited to $3,000 of deduction against ordinary income in any 1 year. So next we have office and home, or the home office. So some taxpayers, they operate a trade or business in their homes and they qualify for the home office deductions. The tax law imposes strict limits on the availability of the deduction. In fact, the deduction for a home office is allowed by exception. The general rule for a home office deduction states that the taxpayer will not be allowed a deduction for the use of a dwelling unit used by the taxpayer as a residence. And the law provides 4 exceptions to the general rule under which a deduction is allowed. The first is the home office is used by the self-employed taxpayer as the principal place of business. 2, the home office is used exclusively and on a regular basis by patients, clients, or customers in meetings or dealings with the taxpayer in the normal course of a trade or business. 3, the home office is a separate structure not attached to the dwelling unit and is used exclusively and on a regular basis in the taxpayer's trade or business. And lastly, the home office is not considered business inventory. It's not used for storage space for business inventory or product samples. So very key things as it relates to the home office. So the first thing is the income limitation. The home office deduction is not allowed to reduce the net income from the business below zero, except for mortgage interest and property taxes that are allocable to the office. And then keep in mind, those 2 things are generally tax deductible as an itemized deduction. So the other costs of operating a home, which are included in the home office allocation, includes rent, home insurance, repairs, cleaning and other services, homeowners association dues, and depreciation on the cost of home. So in the event that, let's say, the home office expenses will cause a loss, again, it cannot go below zero. So let's say a taxpayer had net income of 7,000 and there were home office expenses of 9,000. The maximum home office expenses that can be claimed is 7,000, and the 2,000 unused home office expense would carry forward to the next year. So here we have an example. It says Kiara, a part-time photographer, maintains an office in her home where she coordinates GIS projects and keeps her client records. She allocates $12,000 in mortgage interest and taxes to her home office and collects $11,000 in fees. Assuming no other business expenses, what is her current year home office deduction? Will she have a home office carry forward? And how would this change if she also allocated $2,500 in maintenance and utilities? And this is saying assume that she does not use the simplified method. So in this case, assuming there's no other business expenses, Kiera's current year home office deduction would be the entire $12,000 with no loss carried forward. However, she would not be able to deduct the additional $2,500 in maintenance and expense because, again, the goal is not to create a loss. But again, the only thing that is allowed is the mortgage interest and property taxes. Everything else carries forward. So that $2,500 for maintenance and utilities, she's limited to the gross income derived from the trade or business. So therefore, the $2,500 would be carried forward. So the calculation of home office expenses involves the allocation of the total expenses of a self-employed taxpayer's dwelling between business and personal use. So this allocation is usually made on the basis of the number of square feet of business space as a percentage of the total number of square feet in the residence, or maybe on the basis of the number of rooms that are devoted to business use as a percentage of the total number of rooms in the dwelling. So here again, we see, let's say the home office square footage is 200 and the total home square footage is 1,000. In such case, it'll be 200 divided by 1,000. 20% would be considered the home office percentage. So self-employed taxpayers claiming a deduction for home expenses, they are required to file Form 8829, expenses for business use of your home. In an effort to reduce the complexity of the home office deduction, the IRS has introduced a simplified method, and this is called the safe harbor method, and it's optional. So under the simplified method, the self-employed taxpayer may deduct home office expenses at the applicable rate of $5 multiplied by the number of square feet used in the home office up to a maximum of $300. So ultimately, this simplified deduction, it limits the home office deduction under the safe harbor to $1,500. Same thing applies. The deduction is still limited to the net profit from the business, and any deduction in excess of the income limit cannot be carried forward. So please keep that in mind. The same home office qualifications apply, but no allocations are required. And in the event that a taxpayer chooses to use the simplified method, they're allowed to deduct their mortgage interest and property taxes as itemized deductions. Next, we move on to hobby losses. Right? So if a taxpayer enters into an activity and there's no profit motive, let's say I love to crochet and I don't really want to start a business, I just, want to just crochet, right? The tax law limits the amount of tax deductions that are available in such case. So under the hobby loss provisions, a taxpayer cannot show a loss from an activity that is not engaged in for profit. Despite the limitation, any profits from the hobbies must be included in taxable income. So keep in mind, there's a limitation on losses. However, any profits must be included in taxable income, and it's reported as other income on Form 1040, and it's reported on Schedule 1, line 8. There's some operational rules that we need to keep in mind. So individual taxpayers or S corporations can avoid the hobby loss rules if they can show that the activity was conducted with the intent to earn a profit, because it's definitely when you start a business, there's no guarantee that there's going to be income, especially when you're first starting up. You probably might have a loss. So in such case, to determine whether the activity was engaged in for profit, the IRS will look at the following factors. Was the activity conducted as a business? How much time and effort was exhausted for this activity? What's the dependence on the income for the taxpayer's livelihood? They also consider whether losses are due to circumstances beyond the taxpayer's control. Are there any attempts to change the methods of operation to improve profitability? Previous success of the taxpayer in similar activities in the past, whether the activity makes a profit in some years, and whether the activity is expected to make a future profit from the appreciation of the assets used in the activity. So the tax law provides a rebuttal presumption that if the taxpayer can show a profit from the activity for 3 out of the 5 previous years, 2 of the 7 previous years for activities involving horses, then the activity is engaged in for profit. And as it relates to the loss limitations, miscellaneous hobby expenses, unfortunately, are no longer deductible. So historically, the deduction of hobby expenses have been limited. Hobby expenses, they were deductible to the extent of the hobby income. Of course, unless otherwise deductible, such as mortgage expense and property taxes, and they were claimed as a miscellaneous expense, a miscellaneous itemized deduction that was subjected to the 2% floor of AGI. But due to the Tax Cuts and Jobs Act, the miscellaneous expense deduction for items subjected to the 2% of AGI floor is suspended through 2025. All right, so that brings us to the end of chapter 3, which covers business income and expenses. So now that this lesson has ended, you should have learned how to complete a basic Schedule C, profit or loss from business, describe the tax treatment of inventories and cost of goods sold, identify the requirements for deducting transportation expenses, identify the requirements for deducting travel expenses, determine the requirements for deducting meals, identify the requirements for claiming business education expenses, identify the tax treatment of dues and subscriptions, determine which clothing and uniforms may be treated as tax deductions, explain the special limits for business gift deductions, explain the tax treatment of bad debt deductions, ascertain when a home office deduction may be claimed and how the deduction is computed, and apply the factors used to determine whether an activity is a hobby and understand the treatment of hobby losses.